topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, welcome and good morning. It's another great week, and what a way to start off talking taxes on a Monday morning. We have a lot of fun. We enjoy what we do. When the new tax laws come out, we get a lot of good rest because, we have to go through and read those tax bills to know what's in them so that we can talk about them here, with you and get the information out, to you, our listeners, and to our clients. And, last week was a great week here at Trucker Tax Tools, Tax Talk for You. We got a bunch of new trucking clients. So if you're a trucker looking for great bookkeeping service at a reasonable price, call us at 877-996-2477 or go over to truckertaxtools.com. Again, that number is 877-996-2477. Hey, we're talking one big, beautiful bill. 900 roughly pages of a bill passed by Congress, signed into law by President Trump on July 4th. It extends and expands many provisions of the 2017 Tax Cuts and Jobs Act, TCJA, and it's aiming to spur growth and reduce compliance burdens. Now, I'm not sure about the compliance burdens because it's adding a lot of new twists and turns, deductions that have limitations. So, in my opinion, yes, it should help to spur growth, keep more money in people's pockets with some of the things it's done on the personal side. But today, we're going to talk business and what provisions the one big, beautiful bill has for businesses. And the first one is bonus depreciation. So everybody, talks about depreciation and what we can do with depreciation, whether it's Section 179 or bonus depreciation. What this bill does is full expensing has become a permanent feature of this tax code. Specifically, Section 168K1A has been amended to replace the previously phased down percentage with a flat 100%, thereby putting in place permanently the ability to fully expense qualified property. And it's permanent until they come in and change the code again. You have to like that because, you never know what you're going to get when you get these things. And it says it's permanent. But again, if Congress passes a new law and changes the law, it's not permanent. It's not like it needs a constitutional amendment. It just needs Congress to come in and pass a law to change this. What they've done is they've gone in and replaced the old rule, put the new rule in to make sure that you have this permanent expensing. Under the current law, Section 168K of the Internal Revenue Code provided for bonus depreciation, allowing taxpayers to immediately expense a portion of the cost of qualifying property in the year it's placed in service. However, that percentage was scheduled to phase down after 2022 from 100% to 80% to 60% to 40% to 20% before fully sunsetting in 2026. So this is amended that, and we've got now the 100% bonus depreciation. Now, nothing in the legislature permits taxpayers to amend 23 or 24 to revise bonus depreciation previously allowed at 80 and 60%. Additionally, that 100% bonus depreciation that you get to expense under the new provision does not apply to property placed in service or acquired prior to the enactment date, January 19th, 2025. Property acquired before that date remains subject to the TCJA phase down rules. Talk about complications. So when did you buy the property that you're fixing to put in and want to get depreciated? Now, does it mean buy or does it mean placed in service? We're still got to get some interpretations from the IRS to make sure, hey, which date is the applicable date? Because it's a lot of times if you're looking at buying a piece of equipment at the end of the year, you may have bought it in December, but you didn't place it in service until the end of January when you actually received that contract, or that equipment and that property. So you got to take a look at this and you got to interpret the laws. Now, you got to understand, they said this was going to make the law less complicated, right? Wrong. Got to be looking at those dates. So make sure you got that effective date. New property acquired after January 19th, 2025. So you need to make sure you're looking at your dates. There's a special provision for special depreciation allowance for qualified production property. A new provision under Section 168 allows 100% bonus depreciation for certain qualified non-residential real property used in qualified specific production-related activities. See, complications in this bill as they go. So traditional 168K bonus depreciation applies mainly to personal property. This effective rule expands full expensing to specific real estate investments that support manufacturing and refining. Now just remember, land is not a depreciable asset. The building on the land is. So when you're going through and calculating a depreciation, you need to, and especially on a building and land, you need to know what the value of the land is in the purchase so that you can get your depreciation correct. So there's a lot of important things in this when you're looking at depreciation. And you got to remember some key requirements. To qualify, the real property must be non-residential real property, used as an integral part of your qualified production activity, be placed in service in the U.S. or a U.S. possession. See, they're promoting growth here in the U.S. Have original use beginning with the taxpayer. So it's got to be new. Be constructed between January 20th, 2025 and December 31, 2028. Be placed in service by December 31, 2030. Be designated as qualified production property through an election on the tax return. So you got to make this election. Fun, fun, fun. Hey, nobody ever said that, Congress isn't full of a bunch of people with hot air. You can do that when you read this bill and knowing that there's how many pages in it. There's a lot of carve outs and a lot of crazy things that they do in this bill. As a matter of fact, when you're reading this bill, there are certain sections that you read and you interpret based on what you're reading there. And I'll give you the example, no tax on cash tips. But then later on, they clarify what cash tips are. And it's not just cash, it's, basically any tips that do come in. So there was some other interpretations you've got to put into this bill when you are looking at this bill. So you're going to want to talk to your tax preparer and make sure that you can actually expense everything here based on the qualified property. Make sure you're taking the right amount of deduction. You're not taking too much deduction, and make sure that the way it's going to be done actually benefits you and your business. Because sometimes you're using too much depreciation and you're really only offsetting smaller amounts of income, and you don't need to do the full bonus depreciation on the piece of equipment that you have, because you're already into a much lower rate. And using that depreciation, bonus depreciation at a low rate, doesn't save you as much money as possibly depreciating it over the life of the asset, useful life of the asset. And you'll get better use of your depreciation a few years down the road. We're going to talk about Section 179 depreciation right after this quick break.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Section 179. Everybody's heard that term before. It allows you to expense the asset that you bought. If it doesn't fit under bonus depreciation, or maybe you just need to use a portion of it, Section 179 has increased. So the increased limits provides greater flexibility, a larger first-year deduction for business investing in capital assets. So what they've done is amended Section 179B1 to increase the maximum deduction from $1 million to $2.5 million. Simultaneously, Section 179B2 increased the phase-out threshold from $2.5 million to $4 million. These adjustments are drastically and dramatically raising the ceiling at which small and mid-sized businesses can fully expense the cost of your qualified property. Now, once you get above these limits, your deduction is reduced dollar by dollar for the amount of qualifying property placed in service that exceeds the $4 million threshold. Once the total cost of eligible property placed in service exceeds $6.5 million, the entire Section 179 is phased out. So you still got the complications out there. They're going to also add in new inflation adjustment rules for Section 179. So they've changed that so it'll be indexed for inflation in the future as well. So these are not going to be static numbers. They're assuming more mid-sized businesses are going to qualify for expensing under Section 179. And then you need to monitor the inflation adjustments every year just to make sure that, they're qualifying and how much you can actually expense. Now, something interesting. We talk to businesses, and a lot of our businesses we talk to are LLCs, multi-member, or even single member, so reporting as a sole proprietorship, or they are S corps. And you do business charitable contributions, and your business charitable contributions pass through to your personal return. And if you are itemizing, you get to take it on Schedule A. Now, if you are a C Corp, you're reporting on 1120. This bill is going to introduce a significant change to the rules governing corporate charitable deductions by putting in a 1% floor for deducting charitable contributions. So they amended Section 170B2A, as if everybody really wants to go through and read the IRS code. But if you do, it's Section 170B2A. Corporations' deduction for charitable contributions is in a taxable year will only be allowed to the extent that the contribution exceeds the 1% of the corporate's taxable income. And it also remains capped at 10% of taxable income as it is in current law. So this means if you're running a corporation and you're reporting an 1120, you're not going to receive any tax benefit for the first 1% of taxable income donated to a charity. Or if you give more than 10%, you're going to be limited to the 10%. And sometimes we tell people, especially when you are in business, sometimes it's better to use your charitable contributions to do marketing. Pay them to put your banners and stuff up, have the marketing section of it. So it is fully deductible and not having to face the charities. See, if you're running a S Corp, you're running a partnership, you're running a multi-member LLC tax as a partnership, or as a single member tax as a sole proprietor, marketing sometimes is better deduction for you than the charitable contributions, because you have to get over the standard deduction. If you don't get over the standard deduction, then it has done you no good. So if you're contributing from your business, maybe you want to look at ways of using that charity to provide you with more marketing as opposed to giving charitable contribution. Now, the IRS did put in carry forward rules. The treatment of disallowed contributions is adjusted to reflect the new floor. Contributions exceeding the 10% cap can still be carried forward for 5 years. However, the new caveat, only contributions disallowed due to exceeding the 10% cap will be eligible for the fully carry forward. If a contribution is disallowed solely to not exceeding the 1% floor, it can be only carried forward if the 10% limit was also exceeded in that year. Okay. And then they have FIFO rules. First in, first out. Contributions be treated as used in the order they were made. First in, first out, FIFO. Fun things in life, taxes. That's why we do taxes. We enjoy doing this. This is not effective until after December 31, 2025. So this will become effective in 2026. If you are running as a corporation and you're making consistent charitable contributions near or below the 1% threshold, you're losing the deductibility of that. And it does take away some of the incentive for charitable giving. So sometimes you got to look at this in a different light and maybe look at it that you want to spend it more as marketing. So little tidbits out there. You can really kind of look at how you want to do your charitable contributions. Is it going to exceed the 1% floor? Is it going to exceed the 10%? So maybe you want to limit what you're giving. So those are things to keep in mind when you're doing tax planning and planning for the future, how you're going to save money for your business, where you want to spend the money, and how you want to spend the money as well. Now, this one big, beautiful bill, I guess they call it the OBBBA, One Big Beautiful Bill Act, did repeal the revision of the diminished rules for third-party network transactions. So what is that? Well, a lot of that is your 1099K reporting. So, it got really complicated, and we've seen people that have received 1099Ks, through maybe Zelle, Venmo, PayPal, maybe not really doing or being in business, but using it to transfer money between family members. Maybe like I went and bought a Mother's Day gift for my mom from me and my sisters, and then people reimbursed me. Or one of my sisters bought Christmas gifts for my mom, and we all reimbursed her. And, there may be other things that have happened that, you get reimbursed, you pay for something and somebody reimburses you. And then the reporting company gives you the 1099K. Well, these rules needed to be modified. And it's not going to prevent that if your transactions are still over the limit. But it amended Section 6050 WE. They're only going to be required to issue 1099K if both conditions are met. The total payments to a payee exceed 20,000, and the number of transactions surpass 200 within a calendar year. So I hope there's not 20,000 moving back and forth between family members. Now, this would kind of be funny because my sister would have passed the 20,000 when she bought a vehicle from my mom when she was selling them, but she wouldn't have surpassed the 200 transactions within a year, at least unless her kids and somebody else are transferring a lot of money back and forth. Hey, we don't know. So these are the things that really help. Now, if you're subject to backup withholdings, you've got to be concerned because they may still take the backup withholdings from this as well. So that's kind of, some good things there. So, if you receive 50 payments totaling 5,000 through some kind of craft selling platform, or you were selling eggs because you have fewer than 200 transactions and less than 20,000, the platform's not going to give you a 1099K. Now, if you're reporting, you're selling eggs and you have 1,000 transactions at $5 each, that's only 5,000. There's still going to be no reporting on that because you didn't break both thresholds. But if you're doing some freelance work, consulting work, or something else, and you've received 250 payments and they total 25,000, you're going to get a 1099K. So you've got to be aware of that and know that you're going to have to make sure that you're reporting. Now, the one thing about that is if you're in a consulting business, you're running a business. Whether they give you the 1099K or not, you still should be reporting all your income as well. Hey, when we come back, we're going to continue talking about this one big, beautiful bill and what else it has for your businesses and how it'll affect you. And we'll be right back.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools at 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. We're talking about different things that affect businesses, and one thing that businesses always got to do is send out 1099 miscellaneous or 1099 NEC, 1099 non-employee compensation. But starting in 2026, the threshold for information reporting under Internal Revenue Code Section 6041A is actually increasing. It's going from the $600 that we've been at, that they didn't index for inflation, to $2,000. This change means businesses will only need to file information returns such as 1099 NEC or 1099 miscellaneous if your total payments to a recipient in a calendar year exceeds $2,000. Now, starting in 2027, that $2,000 is going to be adjusted annually for inflation. Adjustment will be based on the cost of living formula under Section 1F3 using calendar year 2025 as the base. And the amount's going to be rounded to the nearest $100 increment. So what I see is it's going to be $2,000, then it's going to be $2,100, and probably then go to $2,200. So we're going to be looking at $2,000 being the amount for 2026. We're still going to be reporting at the $600 level in 2025. So don't jump to the conclusion that you don't have to do the 1099s if you're under 2,000. It's still a 600 for 2025. So you make sure that if you do work with independent contractors, and I tell people this all the time, the first time somebody works for you, get that W-9 before you have to issue the payment, because I'm going to tell you it's harder to get a W-9 from somebody after they finish doing work for you. But if you get it on the very first time, you've already set the standard that, hey, I'm going to issue you a 1099 because I am not going to be responsible for the taxes on your contract labor if I was to get audited. So if I've issued the 1099, it puts the burden back on you. And I'm not the one going to be left holding the bag. So keep those things in mind when you first hire somebody as a contractor. Get them to sign, your contract. Get them to sign and file the W-9 with us. Verify that they are legally here, so you're not held accountable either. You don't want to be doing work for somebody that is here illegally using an illegal Social Security number that isn't valid, or somebody else's. It's just going to get you in trouble. It's going to get you, when you do file your W-9s and your 1099s, when they get kicked back, you're the one that's going to be responsible for trying to find that person and get the correct Social Security number, which I'm sure they've already disappeared. So you want to make sure that you're keeping track of it, keeping the information so that you have good records. So you've got to make sure you're doing that. You can't also count on Venmo, Zelle, whoever you're using to pay these contractors or gig workers or whatever. They're not getting the 1099Ks, so you got to be making sure you're giving the 1099 NECs there. So again, remember, reporting threshold under the current law is $600. Starting next year, it will be $2,000 and then indexed for inflation. Under the current law, we had no indexing. New law will be indexed after 2026. If you're paying for services, the $600 threshold applies this year. Starting in 2026, the new threshold applies. So keep those things in mind. Now, this one big, beautiful bill did things for qualified business income, and it's called the QBI. Now, that was part of Trump's tax law back in 2017. They did do some enhancements to that bill. Hey, I'm going to answer a quick question here. What's the difference between the 1099K and 1099 NEC and the 1099 miscellaneous? The 1099K is coming from a merchant service provider. If you're accepting credit cards, taking Venmo, taking Zelle, they're going to issue the 1099Ks. NEC is somebody that's a non-employee. So, if you've got somebody that's working for you as a contractor, you're going to issue the 1099 NEC. Miscellaneous has several different categories. It could be royalties. It could be rents. So what you've got to do is look at the Form 1099, and you can see the different things that if you've paid for it, how you're going to have to report it. So if you're a business and you're paying rent to individual, you're going to issue them a 1099 miscellaneous for rents out there. You may need to do it for LLCs. It just depends on the qualifications that you have out there as well. All right. I know everybody's been, thinking about this and talking about this is, qualified business income deduction, QBI. It expanded and phased in thresholds for income-based limitations. They threw in a few more complications, and where it can phase in, it added some guaranteed minimum deductions for active businesses. And guess what? Because it's in-depth, it's a long discussion. We're going to take a short break, and then we're going to jump right in to QBI right after this.
We have only scratched the surface of today's show. Please stand by, as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, QBI QBI, qualified business income deduction, section 199A. This changes are going to take effect in tax year 2026, not 2025. But it expanded phase-in threshold for income-based limitations. The amendment increases the phase-in ranges for the W-2 wage and qualified property requirement limitations for single filers. The phase-in window expands from 50 to 75,000. For joint filers, 100 to 150,000. This adjustment means basically more taxpayers are going to be able to take full advantage of the QBI deduction before encountering any income-based restrictions. Now, it did also throw in a guaranteed minimum deduction for active businesses. Now, if you're not active, you wouldn't qualify anyway, would it? Hey, don't know, but that's just the way it is. A new provision in the section 199A, section I, introduces a minimum QBI of $400 for qualifying taxpayers. To be eligible, you, the taxpayer, must have at least $1,000 in qualified business income from an active business that you are materially participating in, as defined by section 469H. Whew. The minimum deduction is going to ensure that small, actively managed businesses receive meaningful QBI, even when calculated at the 20% would otherwise be negligible amount. So they're giving you a whopping $400 on if you have a minimum of $1,000 of income. Beginning in 2027, that minimum deduction and the 1,000 QBI floor will be adjusted annually for inflation and then rounded to the nearest $5. Not $100, $5. So, QBI has been, pretty good as giving small businesses a leg up, giving small businesses who do make money, depending on the phase in and how they're paying people and their assets, a 20% write off on net income. It's been really, really good for people. So, for the way this bill worked, if you were a consultant with QBI of 120,000, a small businessman with a QBI of 100, qualified business income of 120,000, if you were single and QBI was 120, taxable income 135, you would have a phase-in below the 135 to around 170. Under the new law, phase-in doesn't start for a single taxpayer until 193,000 is fully phased in at 247. Therefore, under the new law, you would actually get 20% of 120,000, which is a $24,000 deductible. Really nice. So, at 135,000, you were below the plan. You still get the 24,000 because your threshold would start at around 175. So, little things to keep in mind that are out there. If you're married filing joint, your phase-in ends around 483,000. Now, there's a lot of other problems in this bill. There's a lot of other things that have been issues with QBI, but those issues didn't get 100% straightened out here. Really wish they would have just applied this to all kinds of businesses across the board. But that being said, not everything works the way you or I want it. And there are certain politicians that basically feel that they want you to say, how much did I make? Send it in, and then we'll give you money back that we think you should have. I can't stand those politicians. I can't stand the politicians that try to make these bills more complicated than they really need to be. Now, if you're into green energy, hey, great. You can be into green energy. I've always felt that if you're going to support any industries or anything else out there, it shouldn't be government supported. If you need government support to help you maintain or establish your entity in your business, do it through loans. Make you repay it. Don't do it through tax credits to lower the cost of your vehicle, or the cost of solar, or the cost of electric, or whatever it may be. The businesses, and we hear a lot of people say tax businesses. Well, if we're taxing businesses, it should be every business the same way. So sunsetting a business green energy tax incentives, to my opinion, is great. I wish you would have just said, bam, take them out, they're done. But they didn't do that. So they're ending clean vehicle credits. They're ending the previously owned clean vehicle credits September 30th, 2025. Qualified commercial vehicles credits September 30th, 2025. So if you're looking for clean energy credits, get out there and get the car now before they go away. After December 31, 2025, clean electricity production credits, clean electricity investment credit is going away. Clean hydrogen production credits are going to be going away with some restrictions. So they are sunsetting these laws. If an industry can't support itself, again, is it a viable business? Is it a viable structure for this business? I know we want clean energy. I know we want clean cars. And I know you've got to regulate. But again, that burden should be on the development and the business that is doing it, and the people that are buying the products, not on the backs of every single American taxpayer. Taxes isn't for the redistribution of wealth. Taxes is to support the government in their primary functions. And if you want to know what the primary function of the federal government is, read the Constitution. You can see what's laid out in that Constitution and what the role of our federal government is. It's not what they make it to be. It is developed into what they've made it to be. If you want to know when taxing started, it surely didn't start with the very first Constitution. Taxing the American people started back in 1913. And if you want to know more about the tax code and you're a trucker, come to the Truck for Success that OOIDA puts on. I talk a lot about tax code, where we started, where we're going, and what our future is going to be, and how you can save money on your taxes as a trucker, as a business owner. So go to Trucks for Success, go to OOIDA and look up Truck for Success. Come to this great seminar that we put on for truckers. It's at the end of October. It's up in Blue Springs, Missouri. Love to see you up there. I'll be up there. You should be up there. If you're looking to move from owner-operator out to an independent driver, as a business owner, you should be attending this seminar in September. If you're an owner operator already out there and you're looking to possibly expand, get your own authority, learn all the rules and regulations required to do that. Maybe you want to add more trucks and you want to do the other things to continue to grow. Truck to Success is the place to be. You should be there. I'll be there. Man, come sit down with me in the lobby. Let's talk business. Let's talk trucking. Let me know what you're going to do, what you're most interested in, and how we can better help you as a trucker. So, these are the things that we're looking to do for you. Tax Talk for You. We bring you not just this one big, beautiful bill, business side, personal side. Last week, you can go back to our podcast and hear a lot of the personal stuff that was in this bill. In an hour, we could only get through a portion of what was in this one big, beautiful bill for personal taxes and how it was going to save you money. Next week, we're going to get back to the one big, beautiful bill and how it affects you, the American taxpayer, not the business, on your personal return, and how you can use this bill to save yourself more money. And the money that this bill saved every taxpayer in helping you to make your life better. Now, if you've got a tax problem, trucker tax tools for truckers, we help truckers save money. Taxation Solutions Tax Relief will help you put your life on the right track. To fight the IRS, to get you relief from IRS problems and put your tax debt to bed for good and give you peace of mind to be able to rest. We always tell people, hey, call us at Taxation Solutions because, we can help you fight the IRS, save you money, get you tax relief. We can't do it unless you pick up the phone and call us because we don't make outgoing phone calls until you have contacted us and scheduled a time with us. If you call 888-930-1016, again, 888-930-1016, you can get the help you need to save yourself versus the IRS. And we got people standing by, so don't worry. It's a no judgment zone. Once you hire us, you never have to talk to the IRS again. Hey, tell your friends and family about Tax Talk for You. We need more listeners. We need more questions. We need to answer the questions that you have that have been on your mind for weeks or months, but you were afraid to ask. Contact us through our Facebook page at Tax Talk for You. Contact us through our website, taxtalk4you.com. Or even go to W4CY Radio and listen to this program every month. Every week, actually. Man, I was thinking we're doing this monthly now. No, we do this weekly, every Monday, 10 a.m. Eastern Time. Again, every Monday, 10 a.m. Eastern Time, right here, Tax Talk for You. So go to Tax Talk for You. It's Tax Talk, the number 4, you, letter U.com. Follow us over there. Follow us on Facebook. If you got questions during the week, post those questions. We will be here to help you every Monday, 10 a.m. So connect with us. Be here. Get your questions in. And let us answer those questions on taxtalk4you.com. Thank y'all. Have a God bless, glorious week. Do something great this week. And then let us hear about it. Have a wonderful week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalkforyou.com. See you next week at W4CY.com.